Hey, what's up, stock compounders? Brad here. So today I want to talk about Howard Marks' latest memo. Okay, Howard Marks is one of my kind of favorite investors to learn from. This book here, The Most Important Thing, it is at the top of my list of investing books. And Warren Buffett. Uh, these memos by Howard Marks are on Warren Buffett's short list of things that he reads whenever they come out. So, I first saw this on Twitter here. You can follow Oaktree, but I'm going to pull up this 2020 in review memo from Howard Marks. And it's basically kind of looking back at 2020, but most of it is actually looking forward, trying to anticipate what to expect in 2021 and beyond. And there's some really strong arguments on the side of, we should be optimistic about the stock market. There's also some strong arguments on the side of, all right, we need to take risk off the table right now. There are some real red flags in terms of the stock market. So we're going to get into all of that. But I'm just going to kind of highlight 2020 in review, and then we can get into what to look forward to. The opening lines of Charles Dickens' A Tale of Two Cities offers a fitting coda to 2020. It was the best of times, it was the worst of times. It was the season of light, it was the season of darkness. It was the spring of hope, it was the winter of despair. We're left to contemplate jaw-dropping list of extremes compiled during 2020. The coronavirus brought on the worst global pandemic in over a century. In the US, more than 340,000 people died from this pandemic. 85% of the number who died in battle in the 4 years of World War II. Wow, it really puts things into perspective. In the second quarter, the U.S. experienced the worst quarterly drop in real gross domestic product in 74 years of recorded quarterly history, an annualized decline of just about 33%. But in the third quarter, it saw the biggest annualized gain in history, just over 33%. Initial unemployment claims jumped from 251,000 to almost 3 million in a single week in March, crested at 6.2 million 2 weeks later, and remained above the pre-pandemic record of 695,000 every week for the remainder of 2020. Through bond buying, the Federal Reserve grew its portfolio by 2.7 trillion, or roughly 55%. And the U.S. Treasury funded roughly $4 trillion in grants and loans. That's a lot of T's right there. After the S&P 500 index reached an all-time high of 3386, on February 19th, it fell about 34% in just 32 days to 2237 on March 23rd. I believe that was the fastest drop ever of that magnitude. It was just insane how quickly that happened. But from that low, the index regained the previous high in less than 5 months on August 18th. That is just about equally as remarkable. It ended 2020 up 68% from the low in March and up 18.4% overall for the year. So strong year for the S&P despite the pandemic. Unlike the credit crunches that accompanied past crises, the capital flowed like water. High-yield bond issuance for the year was $450 billion, up 57% from 2019, and well above the prior record set in 2013. Investment-grade debt issuance totaled $1.9 trillion, up a similar 58% from 2019, and also ahead of the previous record set in 2017. After the Fed cut its federal funds rate target to between 0.25%, bond prices rose as bond yields fell in parallel. At year-end, the average A-rated bond yielded just 1.52%, and the average yield on high-yield bonds was just below 4%. So there you go. that's kind of year 2020 in review. Let's look at positioning for 2021. So for those who aren't familiar with Howard Marks, Howard Marks is big on kind of knowing where we're at in market cycles. When we're kind of near the low end of the market cycle, that's when it may make sense to take more risk in the markets. And when signs point to us being kind of at frothy levels in the market, it's time to take risk off the table and be more defensive in our investing. So, basically what Howard Marks is going to do in the rest of the letter is collecting support, collecting arguments for why we should be optimistic, and also collecting arguments, intelligent arguments for why we should be defensive moving forward. I really appreciate that he doesn't just have this clear, this is what I think is going to happen. He's really taking both sides, which I'm a big fan of, especially investing in individual companies, right? You always have to invert the story, like Charlie Munger says, and see both sides. Because the market is at a possibly critical juncture and its direction is much debated these days, I'm going to spend an unusual amount of time discussing positioning going forward. Thus, you might end up feeling this memo should have been titled Preview of 2021 rather than 2020 in Review. Okay, so we're going to read some of the bold points, and as we get to the end, I'm going to read most of that last page. Most important on the positive side of the ledger, we seem highly likely to have a healthy economy for a good while, and the Fed has telegraphed its plan for years of accommodative monetary policy to keep it that way. Now, let's see. This was very interesting. So because of the stimulus checks, real personal income grew at the fastest rate in 20 years, okay, in 2020. Harvard economist Jason Furman estimates that the combination of above-trend income and below-trend spending, because people aren't out, spending, traveling, entertaining, all that stuff, has created roughly 1.8 trillion of extra disposable personal income since the beginning of the pandemic. Finally, add in the very positive wealth effect from last year's multi-trillion-dollar appreciation on stocks and still more on homes, right? So the balance sheets of individual households have strengthened because of what's been happening in the last year. The strong economy will be abetted by a Fed that has promised to keep interest rates low for years and to continue buying bonds, okay? The fact that we already see full asset prices so early in the recovery is a source of risk. But on the other hand, the fact that the economy is likely to grow for several years is very encouraging. He talks about how he believes U.S. political uncertainty has declined somewhat, truncating the extreme tails of the distribution of possible events. With a center-left president and tiny Democratic majorities in both houses of Congress, I believe radical legislation is unlikely to be enacted, which is a positive for the markets. The biggest risk of all, of course, is the possibility of rising interest rates. Okay? Rates have declined quite steadily for the last 40 years. This has been a huge tailwind for investors, since a declining rate environment lowers the demanded returns on assets, making for higher asset prices. So as interest rates go down and down and down over the decades, asset prices go up and up and up. The linkage between falling interest rates and rising asset valuations is a good part of the reason why price-to-earning ratios on stocks are above average and bond yields are the lowest we've ever seen, which is the same as saying bond prices are the highest. You pay more for the same coupon on a bond, you get a lower yield. But the downtrend in rates is over. Thus, while interest rates can rise from here, implying higher demanded returns on everything, and thus lower asset prices, they can't really decline from here. This creates a negatively asymmetrical proposition. So today's high asset prices may be justified at today's interest rates, but that's clearly a source of vulnerability if rates were to rise. This is something a lot of people miss when they say, well, it makes sense that we should be willing to pay more for great businesses because interest rates are so low. Yeah, okay, that makes sense if you're looking at it in isolation. But what happens when interest rates are so low? What does that likely mean for interest rates moving forward? This is a vulnerability, given interest rates are likely to rise. I mean, they have to rise at some point, it would seem. And when that happens, it's pretty clear what's going to happen to asset prices. Let's see. What about inflation? Can the 10-year Treasury note still yield 1.4% if inflation reaches 3%? Will people buy it at a negative real yield? Or will the price fall so that it yields more? Where could inflation come from? The price of goods may not rise in dollar terms, but reduced respect for the dollar could cause it to depreciate relative to the price of goods. Same result. So Janet Yellen made clear she believes it's better to provide too much relief than too little, okay? Asked about the relief package, these trillions of dollars that are being pushed, to U.S. citizens. That's true. It's better to provide too much relief than too little. But that doesn't mean the more relief, the better. And it doesn't mean there aren't risks attached. Okay, those are really important things to consider. So this is a comparison between the 2009 stimulus and what is now being proposed. Okay, this is really interesting. In 2009, the gap between actual and estimated potential output was about 80 billion a month and increasing. The 2009 stimulus measures provided an incremental 30 to 40 billion a month during 2009, an amount equal to about half the output shortfall, okay? In contrast, recent Congressional Budget Office estimates suggest that with the already enacted 900 billion package, but without any new stimulus, the gap between actual and potential output will decline from about 50 billion a month at the beginning of the year to 20 billion a month at the end of the year, okay? So less of an estimated gap than in 2009. The proposed stimulus will total in the neighborhood of 150 billion a month, even before consideration of any follow-on measures. It's pretty clear that there are going to be follow-on measures. At least I think it's pretty clear. This is at least 3 times the size of the output shortfall. Okay, so 2009. The stimulus accounted for about half of the output shortfall. In 2020/2021, 3 times the size of the output shortfall. So this is a relative 6 times as large stimulus as opposed to 2009. So that's eye-opening right there. There is a chance that macroeconomic stimulus on a scale closer to World War II levels than normal recession levels will set off inflationary pressures of a kind we have not seen in a generation, with consequences for the value of the dollar and financial stability. This is big stuff. Okay. Here we go. So the actions of the Fed and U.S. Treasury may be leading investors to aggressively pursue high returns in today's low return world, replacing risk aversion with risk tolerance. Signs that in the past indicated excessive optimism and complacency in stock and bond markets are present today. What are those signs? The strong performance of speculative securities and meme stocks, we've all seen that. Heavy retail buying of stocks, options buying, and buying on margin. Okay, definitely seeing those things. Heated bidding for bond deals, low bond yields, and weak contractual protections. The Buffett indicator, which is the ratio of total equity market cap to GDP, is far above its previous high. And large numbers of IPOs, including IPOs by unprofitable companies, and first-day share price jumps of tens or hundreds of percent. I think just today we saw eToro taken public through a SPAC, and that SPAC price jumped 46%. Okay. Of course, SPACs are included here in the IPOs. Interestingly, Oaktree has 2 SPACs. One they've already found a target, and the other one they're still looking. Okay, let's keep it moving. Finally, much of the worry about whether we're in a bubble relates to valuations. For the S&P 500, for example, the current ratio of price to projected 2021 earnings is roughly 22, depending on which earnings estimate you use. This seems expensive compared to the historic average in the range of 15 to 16. It's a pretty tight historic average. But knee-jerk judgments based on the relationship between current valuations and historic averages are too simplistic to be dispositive. Before making a judgment about today's valuation of the S&P 500, one must consider A, the context in terms of interest rates, right? B, the shift in its composition in favor of rapidly growing technology companies with their higher valuations, right? So it's not like all of the companies in the S&P 500 have these elevated PE ratios. It's primarily these growing tech companies. The valuations of the index's individual components, including those tech companies. And D, the outlook for the economy. With these factors in mind, I don't think most of today's asset valuations are crazy. Okay. Of course, a big correction in speculative stocks could have a negative impact on today's bullish investor psychology. So we could have some kind of domino effect. If there's a pop in the speculative meme stocks, the Robinhood stocks, the heavy short interest stocks, could have a domino effect on the rest of the market. Okay, we're going to check out, this is an interesting paragraph. In particular, as to item A above, we can look at the relationship between today's 4.5% earnings yield on the S&P 500 and the yield on the 10-year Treasury note of 1.4%. The implied equity risk premium of 310 basis points, which is the difference between the earnings yield on the S&P and the 10-year Treasury, is very much in line with the average of 300 basis points over the last 20 years. Valuations can also be viewed relative to short-term interest rates. The current price-to-earnings ratio on the S&P 500 of 22 is slightly below the reading of 24 in March 2000, the height of the tech bubble, and the Fed funds rate is around 0 today versus 6.5% back then. Thus, in 2000, the earning yield on the S&P 500 was 4.2%, or 230 basis points below the Fed funds rate, while today it's 450 basis points above, just because those interest rates, the Fed funds rates, have shifted so much, dropped so much since 2000. In other words, the S&P 500 is much cheaper today relative to short-term rates than it was 20 years ago. Over the course of my career, there have been a handful, okay, we're really getting into kind of the summary of this whole memo. Over the course of my career, there have been a handful of times when I felt the logic for calling a top or bottom was compelling, and the probability of success was high. Success in calling correctly the top or the bottom. This isn't one of them. There's increasing mention of a possible bubble based on concerns about valuations, federal government spending, inflation, and interest rates, but I see too many positives for the answer to be black or white. In the interest of moving toward a conclusion, I'm going to briefly recap the pros, cons, and counter arguments. So we're getting near the end here. The economic outlook is positive, although Chairman Powell warns that the recovery remains uneven and far from complete, with inadequate job creation. Thus, he says the Fed will keep interest rates low for years, but with fiscal and monetary policy extremely accommodative. Rates are already on the move up and vulnerable to increased inflation. Inflation stayed low in the 2010s despite records being set in terms of duration of the economic recovery, deficits, and low unemployment. However, inflation's ability to remain so is uncertain. The temperature of the market is elevated, and there are signs of euphoria and risky behavior. Jeremy Grantham pointed this out in an interesting way, pointing out the activity in the over-the-counter market, the pink sheets market, penny stocks. Just incredible amount of volume in penny stocks over the last year. And if you look month by month, it's going up exponentially. Valuations are high relative to history as security prices have run ahead of economic gains. High multiples are justified by today's low interest rates, but dependent on continued low rates. Okay, I cannot stress that enough, the importance of interest rates and where they're likely to go from here. Risk compensation is skimpy, as seen in the premium valuations of favored companies and in historically narrow yield spreads on credit. Washington poses a risk because of one party's control and the anti-capitalist policies of its most progressive members. My hope is that the narrow majorities render radical legislation less likely. As to exogenous risks, President Biden will pursue greater harmony, but tension with China and Iran and the racial and social divisions at home will continue to cloud the outlook. Okay, so yes, this is the last page. Let's see what I want to pull out of here. With arguments on both sides, I feel the prices of most assets are in a gray area. Certainly not low, mostly on the high side of fair, but not so high as to be unreasonable. The bottom line is this: given current conditions, should investors be at their usual risk position, more defensive, or more aggressive? While the risk-adjusted returns of most asset classes seem to be at rough equilibrium relative to each other, all absolute returns are ultra-low, commensurate with today's equally low interest rates. So this is kind of an argument against using low interest rates as justification for being willing to pay a lot more for businesses. On balance, I think it's appropriate to be in one's normal stance, perhaps with a modest bias towards defense. So, slightly on the more conservative side of risk. That feels right to me, actually. Moreover, the surer one is that rates will soon rise meaningfully. Let me start again. The surer one is that interest rates will soon rise meaningfully, the more cautious one should be today. Because the primary risk lies in the possibility of rising inflation and the higher interest rates that would bring, I think portfolios have to make allowances. Even though we can't predict, we should prepare. One of Howard Marks' most famous quotes. We cannot predict, we can prepare. This possibility means A, bonds with maturities much above 10 years are obvious candidates for underweighting. Okay, move out of those. And B, inflation beneficiaries should be considered for overweighting, including floating rate debt, real estate capable of seeing rent increases, and the stocks of companies with the power to pass on price increases and or the potential for rapid earnings growth. Okay. Pricing power, earnings growth. Those are the businesses to own. In most cases, price has converged with, if not run ahead of intrinsic value. That means it's harder than ever to outperform, other than by taking on additional risk and being lucky enough to do so in an environment where such action is rewarded. This past year challenged many preconceived notions about the economy, markets, and policy, and even changed the way we live. But the inescapable truth of investing remains unchanged. There is no magic answer, no solution other than superior skill that will enable an investor to earn a high return safely and dependably. And that's especially true in today's low return world. That's it, guys. March 4th. So this was written 12 days ago as of today, March 16th. Just amazing. Howard Marks. I mean, the guy is just so concise and, well researched, well thought out. I really appreciate that he makes these memos available to the public. Just great stuff in here. So how is this going to impact my investing? I'm still just looking for businesses that I understand, that I can buy at a compelling discount to what they're worth. So, and also, of course, the long-term compounders, great businesses that are going to be able to compound my money for me decade after decade. So that hasn't changed. If anything, it's harder to find opportunities like that, at least in the U.S. So, I'm going to keep looking. And certainly if the market takes a dip, if things go haywire, if there's massive selling in the markets, those opportunities are going to be much easier to find. So we can see how quickly that happens. Looking back to last March, I mean, it felt like within a couple of weeks, we were at the bottom, and then boom, we were back up like a rocket ship. So it's so important to have that wish list ready, that buy list, those companies that you really want to own, and at what price you want to own them, because it can happen quick. It can happen very quick, and we don't want to miss that. And that reminds me, I'm going to put out a video, hopefully in the next week, on my wish list. What 10 to 15 companies do I really want to own right now, and at what price would I love to own them? And I would encourage all of you to kind of get your wish list in order, because who knows what's coming and how fast it's coming. So anyway, guys, thank you for being here. I hope you enjoyed this memo from Howard Marks, and I will see you all in the next video. Take care.